Valuing a listed company can be a difficult task for an investor, and there are several different measurements that need to be taken into account before a fair valuation is reached. One such measurement is a company's book value, which when combined with other valuation measurements can really help an investor gain an understanding of a company's true value. The book value can then be used in what's called a price to book ratio, more commonly referred to as the PB ratio, which can allow an investor to determine whether or not a company's stock is over or undervalued. Hey everyone, I hope you're doing well. In this video we're going to be talking about what the book value is and how it measures a company's value, as well as be discussing what the PB ratio is and how you can use it to determine whether or not a stock is under or overvalued. Just before jumping in, if you like content like this and want to know more about the stock market, consider liking and subscribing and put the notifications bell on so you never miss an upload. So a company's book value is, as the name suggests, its value on its books. What this means is, it shows how much a company would be worth if it ceased operating, it liquidated all of its assets and paid off all of its liabilities. You can calculate a company's book value by subtracting its total liabilities and intangible assets from its total assets, and all the appropriate information needed to make this calculation can be found on the balance sheet. Let's give an example. Say we have company Y, which has $500,000 of tangible assets, which are just physical assets that can be easily sold, such as vehicles, machinery, buildings, cash, and stocks in other companies. And that company Y also has $200,000 of liabilities, such as loans and accounts payable, and $50,000 of intangible assets, which are non-physical assets that don't have any immediate monetary value, such as accounts receivable, patents, and goodwill. If we use the aforementioned calculation and subtract liabilities and non-tangible assets from the total tangible assets, we will find that company Y has a book value of $250,000. So the book value is a good valuation measurement that investors can use to help them gauge a better understanding of how much a company is worth from a different perspective, which is why it's so popular with value investors. But just measuring a company's total value is not the only thing the book value can be used to do. It can also be used in the price to book ratio, more commonly referred to as the PB ratio. The PB ratio is a useful valuation method that investors can use to compare companies within the same industry. It's not as useful for comparing companies across different industries. This is mainly due to how companies in different industries record their assets differently. The PB ratio compares a company's stock price to its book value, and as such is a good way of evaluating the worth and the value of a company's stock. It's most effectively used in asset-intensive areas, such as investment trusts or utility businesses. That doesn't mean you can't use it elsewhere. You can still use it across the stock market. It's just more effective for companies that are asset-intensive. The PB ratio can be calculated by dividing a company's stock price by its book value per share, or BVPS for short. To calculate the book value per share, you divide the book value by the total number of shares outstanding. Let's give an example. Say company X has a book value of $2 million, it has 500,000 shares outstanding and a share price of $12. We will find that by dividing the book value by the number of shares outstanding, that company X has a book value per share of $4. What this means is that for every share, company X has $4 worth of tangible assets, and typically, if the book value per share is higher than the market price, the stock would be seen as undervalued. When a company's book value per share increases, it should be met by an increase in the stock price as the stock becomes more valuable. But this is only half of the equation. If we then divide the stock price by the book value per share, we can see that company X has a PB ratio of 3. So is this good or bad? Well, a PB value of 3 means that company X's stock costs 3 times as much as its total assets could be sold for. You can think of this as for every $1 of tangible assets company X has, there is $3 of market value. So in other words, company X's stocks are trading for 3 times what they're actually worth. So a PB ratio of above 1 means that you're overpaying for a stock because you're paying more than it's actually financially worth. Whereas a PB ratio of below 1 means that you're underpaying for a stock and actually getting a discount because you're paying for less than it's financially worth. As I like to stress, you should never base an investment decision off of one indicator, and the PB ratio is definitely not an exception to this. You see, a low PB ratio may indicate that a company's stock is undervalued, but it could also indicate that there is something fundamentally wrong with the company, and as a result is earning very poor returns. Similarly, a high PB ratio may indicate that a company is expecting high future earnings and has a lot of investor confidence, but it could also indicate that a company is overvalued. To get around this issue, it's best to look at the fundamentals of the company and compare it with other companies within the same industry. The best way to do this is to look at the company's historic earnings. Are they increasing? And to compare the PB ratio with other valuation methods such as the PE ratio and market cap. As always, I really hope you enjoyed this video and that you've learned something new. If you do like content like this, subscribe to the channel, and if you have any topics you'd like me to cover in future videos, leave them in the comments below and I'll try my best to get to them. Thanks for watching.